Today, we're going to talk about tariffs and why it's disrupting the stock market. The stock market has now moved into correction territory. We've fully fallen 10% off of the highs in the S&P 500. Why is that happening? Well, when you think about tariffs, I want you to think of a tax. That's essentially what it is. It is putting a tax on the movement of goods that are exported or imported from one country to another. Now, in order to understand them, let's go back to why they were first instituted. The general idea is that you're creating some equality, that somebody is taking advantage of something, and so you're putting a tax or a tariff on it so that as those goods are brought in, there is a cost associated with that. And in the US, we don't do a lot of manufacturing. When you find little products, it'll often say made in China. Why is that the case? Well, here in the US, we've believed that China has acted maybe inappropriately for a number of years. So it has been in China's interest, as they've been trying to grow, to say, we want to sell our products. And so China is a command economy. They have not allowed their currency in prior years to freely trade, and they've artificially pegged it low to the US dollar. So they've said, as the US dollar moves around, it's going to be pegged to the value of the US dollar, and it's not free to trade based on supply and demand. Now, why do they want to peg it very low? The reason is because if their currency is low, US companies will say, we can send a lot of US dollars to China and get a lot of products back. In other words, if we manufactured and created all of these products here, we would have to pay people, we'd have to pay for their healthcare, we'd have to do this and that and buy all these products. We can ship it in from China for much, much cheaper, because if their currency is low, when we send our currency into them, it converts to a lot of Chinese yuan. And then, of course, their employees are at least happy enough with the compensation they're getting and so on. And so a big shipment of Chinese goods comes in. US companies are not building, manufacturing, doing a lot of those things. The US has become much more of a service economy, and that has disrupted the middle class. Now, many would argue, and I would agree, that China pegging its currency low really hurts our employees, our business here. If we look at it from the standpoint of equality, one thing that the US can do is basically slap a tariff on those goods that are coming in. And if China has to pay a tax to ship those items in, well, that's costing them some money. And that money is going to the US government, and it creates at least a little bit better equality in that, okay, now we can compete. We can't compete. We can't make these products for as cheap as China can do it, because our employees require more money and all of these benefits. But if they have a tariff, now all of a sudden there's a little bit more equality. So that's kind of a backstory. That's part of an example of why tariffs have been instituted. Now, the problem is that tariffs are often just a general tax on everyone. In many cases, tariffs will get passed on to the consumer. So the products that we buy end up simply costing us more money. It's not so much that these companies or those companies benefit. It's a general slowdown in economic trade and general slowdown in GDP around the world. So the creation of trade, of free trade amongst countries is a very, very good thing. They have products that we don't have. They have commodities that we don't have. We can ship those in. We have commodities that they don't have. We can ship those out. But people need to act fairly. So in a perfect world, it would all be fair. Of course, that's where the arguments come in. And it's always the gray area. Are tariffs a bad thing? Well, we'd always wish that we didn't need tariffs, but maybe it is necessary in certain circumstances. Now, the U.S. has slapped tariffs on Canada and Mexico, some of our biggest trading partners. And that's a bit of a concern, because now we're maybe going to influence them to go elsewhere. You can imagine that if Canada has to pay a lot for goods coming into Canada or being shipped, sending items into the US and getting taxed on that. Well, they might say, well, we'll do business elsewhere or Mexico. And so, of course, again, that's where it gets into that gray area of, is this really going to be beneficial for the US? I think in general, it's a bad thing. We don't want tariffs. We don't want massive tariffs. We want people to negotiate, and it's better to kind of create a better circumstance that way. Now, the Trump administration basically is on this warpath of, we're going to institute tariffs. And is there some logic behind it? Yes, but you got to be very careful about that. These are some of our allies. These are some countries that do amazing things, and we love trading with them as country to country. So we don't want to hurt our customers, and we don't want them to turn away from us because it has helped everyone. But we do need some equality, and we do need some, equaling of the playing field in certain sectors. And that's where tariffs can be used as a tool. Now, if we look at the stock market, as we started January, it was kind of ho-hum. The S&P was just trending sideways. We've certainly seen in February and into March a deeper sell-off. Being down 10% is not that big a deal. It means that stocks are discounted, but it's pricing in a general slowdown in the economy. And that could already somewhat be predicted, because a lot of people think when the Fed starts cutting rates, that should be good for markets. That's not really how it works. Think about why the Fed has to cut rates. We've cut rates a few different times, and it's because the unemployment rate has been rising. The economy here in the US has been slowing in terms of its growth. They're seeing some warning signs and some problems on the horizon, and that's why they cut rates. Oftentimes, as they start a rate hiking cycle, the economy is still chugging along and they're trying to slow it down. Usually the stock market is in a little bit better spot there. So it's when the Fed basically stops cutting rates and the economy is bottoming out. That's the ideal spot from an investor perspective. So we're still in that rate cutting cycle. I would anticipate more Fed rate cuts to come, and thereby more tariffs, more rate cuts, more slowdown in GDP, possible economic recession. All of those things suggest we'll probably have some lower stock prices. But I don't want anyone to think for a second that that's a bad thing. Lower stock prices are amazing. It means you can buy more shares of the great, great companies, the producers of this world. And as you get more shares, you have more ownership. You have a bigger stake in that company. So I want share prices to come down so that my new purchases can be at low a price points as possible. Don't let a good economic downturn and a stock market downturn go to waste. We want to take advantage of that. On the trading side, there's always a better market environment and more money to be made in trading as stocks go down. There's an old saying that the stock market takes the stairs up and the elevator down. That speaks to the speed of markets. So downward moving markets are amazing. They're an opportunity to capitalize on faster moves, bigger percentage moves. We don't want that to go to waste either. If you're new to the Cashflow Academy YouTube page, make sure you hit that subscribe button. Check out the next video here. Hit the bell to be notified, and we'll see you on the next video.